From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, PCE inflation data coming in line with estimates, still remaining above the Fed's 2% target after this week's rate decision. As markets brace for President Trump's sweeping tariffs to potentially take hold. But we begin with the big issue. All eyes on President Trump's tariffs.
People are taking the president very seriously on the tariffs, probably more seriously than markets are taking.
There are near-term inflation effects when you are when you're implementing tariffs.
This is very wide tariffs at a very high level with major retaliation.
We don't really know what's going to happen to tariff ever. I mean, it could change on a dime.
We have a number of risks that are evolving here in terms of telling us what the outlook might be.
How is the Fed going to manage through this environment of heightened policy uncertainty?
They're cutting rates to make sure they don't get a weak economy. And now we're coming into the tariffs. So I think it is a vulnerable spot.
It wouldn't surprise me if the Fed is tempted to stay on hold until the summer.
We think they're on hold at least through the first half of the year, and then it's really a wait-and-see game to see how these various policies work out.
And until we know the sequence of policy, the magnitude of policy, the Fed can't front-run that.
Now, I want to look at the two-year Treasury yield because it's pretty much steady, even with all the headlines and volatility in other areas of the market. You even have a decrease in yields. They have headed lower over a 5-day span. You might remember earlier this week with all that scare in big tech, you had a haven bid into the bond market. And of course, a relative calm after economic data and that Fed meeting, which we will talk more about. But let's step back. Let's flip up the board. Let's look at the MOVE index, because you'll see the volatility trend even more when you zoom out. You're looking at the lowest levels of volatility, according to the MOVE index, in years, really. You're actually seeing levels really subside heading into this year, which is not what many would have expected, frankly, when it comes to all of the policy uncertainty being presented by the Trump administration. But when it comes to Jay Powell and, of course, the Fed chair, his comments this week, he took a cautious approach for how the Fed is planning to adapt to fiscal policy.
We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be.
Joining us now, Collin Martin, fixed income strategist at Charles Schwab, and Amaury has head of fixed income at Amundi, which is, of course, Europe's largest asset manager. And Collin, we showed that screen a little earlier, the MOVE index subsiding, a relative calm in the market. How long does that calm last for, honestly?
I think that's the million-dollar question. But I think if we look at short-term rates and how that ties into market volatility, I don't think we're expecting much movement right there. When we heard from Powell and what the Fed's looking at right now, it's too hard to really put some sort of final destination about what all these tariffs and tariff threats mean for the economy and for inflation. So as it stands now, we don't expect much movement for the Fed. They're probably going to stand pat at least through the second half of the year or into the second half of the year. And I think more of the volatility is probably going to come from the long end and potentially the credit markets. I think that's an area where you have this, it's super calm, super serene. Spreads remain at their lows when what we see is a lot of risk and a lot of uncertainty out there.
Almost uncomfortably calm. It's interesting when you talk about the long end here, Amaury, one of the things that really caught our eye is the call you made about the 10-year earlier this month. This idea that the yield could exceed 5% again. We are comfortably around 4.5%. We're even 10 basis points lower or more than where we were right before inauguration. Do you still believe that that 5% level can be tested, and what would get it there?
Yeah, the way I see it, and what I said a few weeks ago was to say that I was seeing a probability to reach 5% by around 30%. And it was, I would say, a consequence of the uncertainties about the trade policies and the Trump policies around immigration and tariffs, as you said. I think from my point of view, short term, we have, let's say, finished this sequence around this uncertainty of the Trump policies. there are still uncertainties. We reached the 480 level on the 10-year treasuries. Since then, we have slided back to 450, as you said. And the way I see it is I think the market now, short term, in the next few weeks, will be more dominated, I would say, by, the economic data than by the Trump uncertainties. There are still uncertainties, but I think now the narrative of the market will be really focused on the economic data. And on that front, I think short term, the economic data is more on the weaker side. Obviously, we saw it in Europe today, or yesterday, sorry, with the GDP numbers that was weaker than was expected. You saw it as well with Christine Lagarde talking about risks on the economy. And therefore, I think short term, I don't see the treasuries going higher than the 480 that we saw. And actually, I see more the opposite. I see higher probabilities to slide a little down from this level in the market, basically.
Fascinating. It's a market that is fast changing. And when you look at economic data, we're a week away from Jobs Day. Collin, do you worry about any hints in the labor market that has otherwise shown itself as so strong?
Right now, not hints of weakness. I wouldn't call it so strong. I'd call it strong. It's moderated, but I think it's a good thing. I mean, it's normalized right now, and if we look at the big picture, the unemployment rate's in a good place. We're seeing some kind of leveling out of the quits rate, the hires rate. So we think it's in a good position, and we're not expecting any surprises there. I want to go back to Amaury's points about the yield and could it exceed 5% in timing. And he's brave for giving a timeline. We don't give specific timelines, but we do think it can get to 5%. But I even say it can get to 5% without even factoring in the potential impacts of the Trump policies. And if we look at where we are right now with a resilient economy and sticky inflation, a positively sloped yield curve is a good thing, and it's indicative of a healthy economy. And that yield spread is still relatively low. So if we expect the Fed to, say, cut 2 more times by the end of this year, that still allows room for the 10-year to get up to, say, 5%, because that would still only be about a 100 basis point spread. And again, that's a good thing. That's indicative of a healthy economy.
You know, it's interesting. You said, notwithstanding Trump's policies, that you could get there. But Amaury, you think about just what might be expected in a day. This idea that Trump wants to put more significant tariffs on Canada, on Mexico, on China, and uncertainty about whether you see those really start to come as early as tomorrow, at least with some sense of certainty. Maybe rolled back later. That's another risk a lot of investors are accounting for. How do you take into account the tariff strategy into your calculations about the bond market, given a lot of investors are concerned about inflation?
I think everyone has really said it. There are many uncertainties, and it was said by many observers in your show that we don't know. And therefore, I think the way we are taking that into account is really in terms of probabilities and momentum and narrative of the market. As I said a few weeks ago, and since September, the narrative was really focused on that. It's not the case anymore, and I think we will focus now on the economic data. And coming back to your question, let's say around the 480 level, there were still uncertainties. But I think at this level, the uncertainties are still, and the probability to go much higher starts to be lower given all the uncertainties. So this is the way we look at it. It's really in terms of risk reward and probabilities of outcomes.
If you think about those probabilities, those range of outcomes, how then, Collin, do you account for those policy uncertainties in the direction of a 10-year?
Yeah, that's what we're trying to figure out right now. And our main outlook and what we're telling our clients at Schwab is that there's this wide range of possibilities and potential outcomes, and we expect the 10-year to trade in a wide range. When we talk about the idea that it can touch 5%, that's not our forecast for the next week or month. We think it can just trade in this wide range, though. Maybe it's 4.25% all the way up to 5%. But what's more important for our investors, a lot of individual investors, is that yield. We think that's attractive in the grand scheme of things, and we're not worried that we're suddenly going to see a surge even higher than 5% or say 5.5% or 6%. So those investors that are worried about an interest rate risk and what could happen if yields rise, we're not worried that they're going to surge significantly higher. But as a result of that, because of the risk of upside, we're focusing more on a benchmark or below average duration to kind of mitigate that.
Amaury, from where you sit, for the final word, what is your biggest conviction trade at this juncture?
Oh, there are many of them, but you're asking one. I think regarding, I would say, investors and finance investors, I do believe that they have to invest into real rates and therefore into inflation bonds. Because we said it, and I agree with Schwab, is that 4.25 to 5% is a good level more or less to invest. The only risk to that is inflation. Is inflation higher than what we expect? Then we have an issue. On real rates, you are protected against inflation. And the way the market is pricing today forward inflation is really it's not on the high side. We are pricing the level of inflation exactly the same way that it was priced before the COVID. And with all the current uncertainties around, let's say, demographics, energy transition, deglobalization, pricing the forward inflation at the same level that it was priced between 2000 and 2020 is on the low side. So therefore, on real rates, tips between 2 and 250, or in Europe, let's say OATs, French OAT, between 1 and 1.5, I think it's a good long-term opportunity for investors to buy.
The production room going crazy because we are talking now about real yields on Real Yield. Collin Martin of Schwab and Amaury of Amundi. We thank you both for joining us. Up next, we're going to talk about the auction block. All that credit. January high-grade sales finished the month just $3 billion short of a record high. Issuance is strong. We're going to talk about that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we're going to keep it in the U.S. this week because there was a lot going on. Starting with treasuries, we had auctions for the 2, 5, and 7-year, the combined sales totaling more than $180 billion. Only the 2-year with a slight tail. Looking at U.S. high grade, the January monthly total beating forecasts and falling just short of last January's record of $189 billion. Oracle, NextEra Energy, and JP Morgan helped drive sales for the week. And the U.S. leveraged loan market notched its first $200 billion month of launches. That's topped the record set just last month. The 30-day volatility for spreads is also at its lowest level since September of 2023. Earlier this week, PIMCO's Sonali said she would actually welcome some volatility.
When we look around at around the growth in the broader economy, our GDP expectations, inflation expectations, you can see this type of environment last a lot longer than maybe historical percentages would suggest. So yes, spreads are tight, but the yield's still attracting inflows into these asset classes. And in terms of, a little bit of spread widening on the margin, I think people would welcome as an opportunity to have a little volatility and better return potential as a result.
And joining us now, Maureen O'Connor, Global Head of High Grade Debt Syndicate at Wells Fargo, and Meghan Graper, Global Co-Head of Debt Capital Markets at Barclays. And, if you think, Maureen, about what you expected coming into this year, are you saying we're exceeding expectations, in line, or below?
I would say we're in line with expectations. We were expecting this year to be a big issuance year, in part because it's a big refinancing year. We have some really large redemption towers in 2025 and even more so in 2026. So when a company thinks about their maturity stack, obviously getting in front of some of those maturities, rolling those maturities longer, this is what's driving the vast majority of issuance right now. But on top of that, it's being met with a growth in capital expenditures as well, particularly with respect to the power and infrastructure spaces. And then, an uptick in M&A activity, which I think a lot of folks are predicting this year as well. So when you combine those three things, there's a lot of reasons why this year is going to be a big issuance year. And January was obviously a prime example of that.
Now, I also want to bring some breaking news to the audience here because, of course, something investors are watching very closely, when we might see those tariffs. Apparently, according to Reuters, Trump tariffs on Canada and Mexico will begin on March 1st, so just over a month from today. We will keep an eye on the moves in the market as we go along. The Canadian dollar has already risen to a daily high on the reports of that delay because, of course, they were expected as early as tomorrow. Now back to the debt markets, because of course they are very tied to what we're seeing in the macro economy as well. It's interesting, Meghan, to see such calm in the markets when there's so much policy uncertainty. When you think about this flood of issuance, is there something investors are trying to get ahead of?
I think, we've remained reasonably well insulated. And I think that's a function of the just sheer amount of demand that continues to hide out in investment grade as a safe haven, tied to the strength of some of the corporate fundamentals that we're seeing. And you saw that this week where investment grade managed to shrug off the AI-induced volatility that we saw to kick off the week. I mean, you had 640 billion of investment grade equity value wiped out on Monday. And in credit, given the amount of demand that continues to hide out there, we widened a single basis point. We widened 2 basis points in tech by comparison. So that was contained to a single day relative to what's playing out in other asset classes. And even in high yields, triple C's gapped 14 basis points and have yet to recover. So I think there's an insulatory trade that is driving some of the liquidity into our market. I think that's paired with the largest income weeks on record between bonds maturing. So you've got all COVID-related redemptions coming due, returning principal to investors, and coupon income that is going to exceed 400 billion this year, almost all of which will get reinvested back into the market. So it's technicals colliding, and I think presenting a pretty opportune backdrop for borrowers.
Maureen, it's interesting because you saw, yes, volatility in stock markets, but you actually saw volatility subside in bond markets to the extent that you also saw yields really take a breather. You're looking at a 10-year that's more than 10 basis points lower today than it was right before inauguration. What's the spillover effect into credit markets to see that kind of calm in the longer end of the curve?
Well, I think Meghan puts it accurately insofar as that it's the technical environment that's creating this kind of cushion around our asset class. We have cash coming in from ETFs and mutual funds, from pension funds and insurance companies. Yields are still elevated. This is what's going to keep a lid on credit spreads from going that much wider. So I think, all of those things combined are supporting this robust issuance calendar and keeping spread volatility exceptionally low. So it is our call that probably over the course of the year, credit spreads do come under a mild amount of pressure, just considering some of the unknowns, trade policy, fiscal policy, potential fears around inflation getting stoked later in the year, things of this nature. But it is the cash that is in our market seeking yield right now that's ultimately going to keep things pretty range bound from a spread perspective. In terms of base rates, I mean, this is interesting insofar as that when you think about what makes up corporate yield right now, 85% of corporate yield is made up of treasury yields right now, and only 15% by spreads. That's a multi-decade tight for that metric. So when you think about what's going to be the driver of return in our market, it's going to be the macro environment, right? Meghan points out fundamentals in IG credit are strong. We're likely to have a range-bound environment for spreads. But to the extent you do see an uptick in volatility in rates, which we had at the beginning of the month, remember, we were, roughly 30 basis points higher in 10-year yields not that long ago. That begs the question, okay, how do I generate real return in this asset class if indeed we are looking at an environment where the Fed is on hold and on hold probably for a prolonged period of time?
Meghan, if you think about where people are looking for a return, the leveraged loan market and the boom in issuance and the excitement around a comeback here, are you watching investors really now looking to take on more credit risk and really go down the credit curve in order to seek more returns?
Yeah, we're seeing that. We're seeing down in spectrum trades, there's a willingness to play down the capital stack as well. So we saw a bit of a rebirth in the corporate hybrid market as an indication of that willingness to tolerate risk and to play, down the capital stack as a way to achieve that. Arguably one of the more vulnerable subsets of the market if we start to see an increase in rate volatility. And yet you're seeing order books for that type of asset class 10, 12 times oversubscribed, given how many investors are all chasing and running through the same door, trying to achieve that pickup in yield. So I do think there's a willingness to move down into triple Bs as an opportunity set. We'll get the first signs of life from corporate borrowers as we move into next week. I think an emergence of triple Bs as they come out of self-imposed earnings blackouts, and we'll get a great eye line in terms of the health of that market. We brought a deal for SLM Corp, a deal that was sold to investment grade borrowers despite having high yield ratings, and they came on a Fed day, which is a bit renowned for seeing an absence of activity. Just to me indicative of how much cash is searching for yield, is willing to dip down for the right credits in a selective way, but arguably finding those opportunities and having successful outcomes for borrowers as a result.
Really quickly here, Maureen, what is the biggest risk to this exuberance that we're seeing?
Well, I think two things. I think, as you know, we're sitting at ultra tight valuations from a spread perspective, right? So the market is kind of priced for perfection in that regard. And in an environment like this, where there's limited upside in terms of excess returns to spread-driven returns, it does introduce more idiosyncratic risk to the market, right? So, you know, the decorrelation trade happening, and you have seen that in specific credit stories play out over the last year or so. So I think investors are a little bit concerned around, you know, exactly where that next shoe is that's going to drop. But I'd say the longer-term risk is probably inflation, right? I mean, I think, you know, if we do see a move higher in inflation, rates move along higher with it, you start to get concerned about the Fed really trying to move into a more prolonged pause or potentially into rate hikes. Then we start to worry about negative returns in the asset class and people shying away from what's been a pretty advantageous entry point in a pretty stable environment for the last couple of years.
Maureen, Meghan, we thank you both for your time today. Of course, January was something else. Maureen O'Connor of Wells Fargo and Meghan Graper of Barclays. I want to bring you back to some of that breaking news a little bit earlier. The news from Reuters saying that those tariffs on Canada and Mexico will start on March 1st. This is an expected announcement, and the announcement will offer a process for countries to seek redemptions for certain imports, according to Reuters, and no decision is final until a public announcement. Stick with us. More ahead. This is Bloomberg.